In our last episode, we talked about what's happening in the economy and why interest rates are improving. In this episode, we're going to explain how buyers can actually take advantage of that today through programs like a 2-1 buydown and what it means for their monthly payments. Welcome to the Heart and Home Podcast, hosted by the thoughtful leaders and siblings from the third generation of DeYoung Properties. All right, everybody, we are back for part 2 of our Heart and Home podcast. And last episode, we talked about the Fed, the economy, rates. And today we are going to be talking more with Tim O'Hare with DeYoung Mortgage, our loan officer at our affiliate company, and really diving into what this really means for our buyers and how it can help them and benefit them if they're looking to purchase a new home this year. So we have Ryan, our president of DeYoung Properties, and we have Brian Ullman, the managing partner at Ford Financial Group here, and we have Tim O'Hare. Thanks everybody for being here today.
Thank you. Glad to be here.
Okay, so Tim,
Yes.
in the last episode, we talked about the Fed and the mortgage-backed securities and why interest rates are easing. From a lending perspective, how have you been seeing that play out right now for our customers and what that means to them?
Interest rates have dropped considerably over the past year, which is makes it a better buying power for the borrower. So I took an example from Freddie Mac 1 year ago yesterday as compared to today.
Yeah.
And so interest rates a year ago were on an average rate, this is average over the entire conventional lending mortgage market, for 7.03. And it has just dropped down to 6.04. So almost a 1% drop year over today. Yeah. So what does that mean payment wise? So I took a simple loan of a $400,000 loan compared at the 7% rate compared to the 6% rate today. So the payment has went from $2,671 to $2,413. So that's a $257 a month savings in monthly mortgage payments. That is. So that obviously is going to help out on the family budget, or maybe more buying power if you want to buy a little bit higher priced home. But it just makes it significantly better for the economy as a whole, for the people that are able to buy the homes today.
Yeah. And that's before any of the tools that we have to help try and lower monthly payments as
correct.
well. Yeah.
So working with DeYoung Mortgage and DeYoung Properties, we're affiliated obviously. You guys do offer some good seller incentives for the buyers. And so what that does is that there's a certain dollar amount that's applied to each transaction that I can use that money as what we call a rate buy down or a discount fee. So the scenario I just gave you, I can take that interest rate, say an average rate of 6%, I'm buying it down now to a 5.375 rate.
Love to hear
So
that.
what does that do? That now drops the payment another $179 per month, a comparison of what it was a year ago. So that's a significant amount. So if you compare that to, and I hate to say, resale.
Or as I call the used home market.
Yes,
used.
Yeah. It has been used.
So the difference is that
those.
we're able to offer these incentives. And so if you bought a $400,000 resale home versus a $400,000 DeYoung mortgage home, or DeYoung Properties home, I should say, our payment's going to be almost $180 less per month.
One question actually for Brian here, this wasn't part of our script here, but when you're comparing a new versus a used home, there are some things that builders can do and to offer, whether it's incentives or different things to help on that monthly payment side, that is different from the resale side. I mean,
Sure.
Can you talk to that a little bit?
Yeah, well, I mean, I think it flows through when you're looking from a personal financial planning standpoint. You're not just taking the mortgage into account. What's the cost of electricity? What's the cost of maintenance on the yard? Right? And so for every dollar that you're saving on the mortgage, that can go. You're reducing the overall cost, and so that can help pay for a gardener, or that can help go to the PG&E bill that's
Or
higher than,
Brian.
or you can invest it in your 401k. That's exactly right. But it's meaningful savings that isn't just dollars and cents that we're talking about. It actually turns into things, right? And so it's a big difference.
And two other things is newer homes are going to be more energy efficient typically, so that's going to be a significant factor on that monthly payment and that budget and that savings. But also, if you are buying a used home, typically they're not going to have that kind of an incentive. The homeowner isn't offering rate buy downs like builders can offer in these types of scenarios. So,
it's pretty rare that I see someone buy a home that's not new and they're not immediately putting paint into it or
Yeah.
new carpet or so that you've got those other costs that come in.
Yeah.
Exactly.
Some may be expected, but some could be surprises.
Certainly
too.
unexpected, plenty of those.
Yeah.
So I wanted to talk about the 200 billion mortgage-backed securities and what that did last week in DeYoung mortgage world.
Yeah, it was pretty shocking.
Yeah. So you came in that morning and said, hey, this just happened. What happened in the market with the rates? And I said, I haven't checked them yet this morning, but as of last night, we had 3 pricing improvements in one day. That's significant. I haven't seen that in quite a while. So that's very exciting for the customers who haven't locked their interest rates in. Yeah. We can do it
Go
at the
even
lower
lower.
rates. Yeah.
Yeah.
And if you didn't catch the news about the 200 billion in mortgage-backed security purchases, tune into episode 1 of this series where we talked to Brian about what that scenario is all about.
Yeah. And so what's exciting is with DeYoung Properties right now, like Tim had mentioned, we are offering a New Year, New You savings event. But what that means is we're trying to help lower monthly payments. And so we're doing a 2-1 buy down. And the week before that all happened, I put all of the monthly payments that we could get to on our website. And then that happened. And I had to update everything because it went down again. So it's just
Very
a good
news.
sign, and it's a good problem to have. I don't mind continuing updating it and helping our customers get as low as they can on their monthly payment. Right. So, why does the rate often respond before people hear about the Fed cuts? Doesn't that seem to happen?
Yeah, I think Brian might be able to answer this better than I can, but the market has already reacted before the actual event has occurred. Is that?
Yeah, that's exactly right. Yeah, when you're investing, you're trying to look ahead to what's coming as opposed to what's going on right now. And so, if there's an expectation of a Fed rate cut, like there was in December, the markets have priced in like a 95% chance of a rate cut. Investors are already moving on that. They're not waiting for the news, and so that's where you can front run that a little bit.
So it seems like everything's trending in the right direction, which is a good sign.
Yeah.
Yeah. So we are offering the 2-1 buy down. Let's talk about that, what it is, how it helps our customers.
Okay, so the 2-1 buy down is it's based on a 30-year fixed rate mortgage overall. So the first year, let's say the starting rate, I'll just use the 5.75 as a start rate. That would be your note rate on the mortgage loan. So the first year, it's 2 percentage points less than the 5.75. So your starting rate would be at 3.75 rate for the first year. The second year goes up to 4.75, and then years 3 through 30 are at the 5.75 rate. Now, that there is a cost associated with that, but the bonus is that the seller is paying for it. So it's not coming out of the buyer's pocket, but they are going to get a much lower payment starting in when they move into their home. So I think that kind of helps them as far as their budget, getting used to what's going to happen. You were talking earlier about PG&E bills and everything else that goes along with a new purchase. I think it just will make them a little bit more at ease knowing that their payment's going to be lower to start out with. Now, it is not an adjustable rate mortgage. It just adjusts up twice, first year, second year, then the third through the 30
And
year.
it's fixed from that point forward.
It's 30-year fixed the entire term.
What kind of buyer benefits from it? Or is this is something that could work for anybody? Because some people I could say, it might be nice because I'm not going to live in the home for forever. So that's great.
It does work for conventional lending only, not jumbo loans. So if you have an FHA loan, a VA loan, or a conventional loan, all those programs would be able to be applicable to the 2-1 buy down.
I would think also it would really benefit new home buyers, for first-time buyers.
Yeah.
Because if you're moving from one home to another, you've got some stuff. But if you're moving from somewhere where, first-time home buyers need to fill the place with furniture and pots and pans and all that other stuff. And so having a break for those first couple of years on your mortgage can go directly into those moving costs, frankly.
Yeah, there are 2 other scenarios too that could be very advantageous to somebody who wants to do this. Is a young professional or a growing family that they expect to have their salary or income going up over time. First-time buyer, prime example. That would be a great scenario where, okay, I think that my take-home pay is going to increase over time, then I can match what that monthly payment's going to land at. And the other scenario is the fact that, like you said, you could be moving. That could be a short-term time frame. But the other thing I was going to say is...
But even at the 5.8 whatever interest rate it is. It fluctuates, obviously. I'm not going to quote just one, but even that, if that's the life of the loan, that's a good rate.
It's a very reasonable mortgage over time.
Well, you know exactly what your payment's going to be.
Yeah.
It's not, and there is a possibility if rates do drop, you can always refinance and drop it as well.
Well, that was my second thing was if you do it and you take advantage of that, lower payment for the first, year or two, and rates do come down, which, most likely I would hope and expect to see rates coming down. You could refi and then permanently get down to a lower payment.
Correct.
So there's that possibility as well.
There's not a prepayment penalty to do so.
Yeah.
Nice.
And I do want to preface this and say we are offering 2-1 buy down right now, but that's not the only tool that you can do. You can do permanent buy downs that are just permanent for the full 30 years too.
Yeah.
So there are options there too. But
Why would somebody choose the 2-1 buy down versus the permanent?
I think it's more of a personal thing. Maybe when you first get in your home, you know that you just had a child and you're going to have maybe some child care costs for the first couple of years. So therefore, maybe you want the lower payment to start off with, and then you know what it's going to be, and you can afford it after maybe the child care is done after 2 years. I don't know. That may be a little bit limited, but as opposed to maybe buying the interest rate down entirely, you can get it right now. I can buy them down to like 5.25. So if the customer can afford that payment. Right off the get-go, why not go with the lower rate over the full 30 years? I mean,
very scenario based.
Yeah, it's all going to be dependent upon that particular client situation. Where do they stand today, and what are they looking at in the future?
What type of loans do you see our customers doing lately? And like FHA, VA, conventional? Talk about what we've been offering.
Stats for the past year were more conventional than FHA and VA. I would think right now, personally, that FHA is a great market because the rates are even lower on those than they are conventional loans. So for the first-time home buyer, fantastic program. There's a less down payment requirement than a conventional loan. Payments tend to be a little bit cheaper because the rates are a little bit lower. And then credit-wise, a little bit more lenient. Income-wise, a little bit more lenient. So again, depending upon the particular customer that we're dealing with and what they want out of their loan, we can look at different scenarios for them.
What about the down payment? How much should buyers be thinking that they should be saving, and what have you been seeing recently for down payment?
That's a great question because we have programs with no down payments. We have programs with 3% down payments, 3.5%, 5%, depending upon their qualifications, their credit. It can go, there's a wide spectrum that we can go over. And in fact, just recently, we have a lender that we're working with that actually goes down for those that are a little bit credit challenged down to a 500 FICO score on an FHA loan program, which is insane to me. But I'm glad that they're able to offer it because some people maybe just had a little hiccup in their lives. And they want to get back on track and get to be a homeowner, and they can now with even lower credit scores.
I mean, that's particularly good for people whose finances were disrupted through layoffs because of COVID, right?
Yeah.
I know it feels like a long time ago that we were all wearing masks, but it really wasn't. And so even just 5 years ago, a lot of people were impacted, and so that could help those people too.
Absolutely.
Can we offer the 2-1 buy down on a new build where you get to pick everything and build the home from the ground up versus a move-in ready? Are you able to offer it on both?
You can. The only difference is on a move-in ready, you're probably going to be locking in your interest rate today because you're looking at maybe a 30 to 60-day window as far as completion. Whereas a new build, we're probably not going to lock that interest rate for maybe 3 or 4 months from now because we usually lock about 45 to 60 days outside the close of escrow. So the only question would be, okay, rates are at what they are today. In 4 to 6 months, are they going to be lower? Are they going to be higher? Not quite sure. Let's pray that that's going to be the lower end, but that's the only big difference on the 2-1 buy down is I wouldn't know exact rate until we move out a little bit further.
I do joke about the resale market and calling it the used market, but if you did have to purchase a resale home, could you use DeYoung Mortgage on the lending side?
Yeah, we're not. I can do a loan anywhere in the state of California. I'm licensed, so it doesn't matter if you're resale or I would rather do it with DYP just because we're affiliated. We want to make our company stronger, but I'm absolutely open to helping out resale customers as well.
And these various programs, you can use these on a resale home as well, too.
You can. The only thing is on the 2-1 buy down that the guideline is it has to be paid for by the seller.
Got it.
So the buyer cannot initiate that. It has to be paid for by the seller. So if you have two parties that are willing to move in that direction, I can help coach guide the seller on why this would help. Maybe sell your home a little bit quicker, or maybe for more money than it's possibly on the market for. I don't know, but I'd be more than happy to discuss that with any realtors out there that want to talk about the program.
Right now, we've had a lot of customers who have a low interest rate where they currently are, and they don't want to move out of that home or lose the benefit of that interest rate. What is something that they could do as a clever alternative if they want a new home as well?
So my idea would be, okay, you got this great rate and you want to move into a new home. You got a ton of equity in that property. We can offer a home equity loan or a HELOC line of credit on that home. Interest rate is going to be a little bit higher than the 3%, but what you're doing is you're tapping into that equity to maybe use as a down payment for a new home. So you're not delving into your savings. Say you rent that property out, you're probably going to be able to rent that out for more than what you owe on it based upon a 3% rate. So you're building equity with somebody else making the payment for you. You're getting a new house that you want to get into, right? So I think you're going to have a happy little world everywhere. The person who's renting your property is probably getting a little bit lower than the market that they might get in an apartment complex. I don't know. But it's a scenario that we can talk about, take a look at it if it fits you.
I think we've had at least 3 or...
I've had actually probably 5 in the last 6 months of going that way.
What are your thoughts on that, Brian? Have you heard of...
Well, I actually have. With the lower rates, it makes people who maybe otherwise wouldn't want to be landlords suddenly pencil this out and say, yeah, this makes a lot of sense that I can keep this house. And I think as you lever up and borrow more, you want to be even more mindful that you've got your numbers right.
Yeah.
It doesn't mean it's not a scenario, and like you said, I've seen it go on more and more just because it's just a side effect of having really, really low mortgages for a while.
Yeah.
You just need to be very mindful because you're borrowing on top of borrowing, and so you got to make sure that the numbers pencil out.
What about 401k? Can anybody use that as their advantage for buying a new home?
Absolutely. So usually it's for first-time home buyer, or most people use it as a first-time home buyer, but you can use it whether you're buying your second or third or fourth home. You cannot use your 401k, to my knowledge, tax-wise, if you're buying an investment property. So what you usually can do is say you have a 401k, you can borrow against that money because it is your own money and you're going to pay yourself back. So I don't believe, I'm not an accountant and I'm not an attorney, but I don't believe that there's any type of tax ramifications for doing so.
You can do, some of it depends on your 401k and what the rules are surrounding it at work, but yet 401k loans are certainly an available option to you. Probably better to go with some of the options that you talked about before, but it's a tool in your toolbox certainly to use. Yeah.
So somebody pulls it out, uses it as a down payment, and then they pay themselves, and then they pay themselves back later, basically?
Well, usually it's through payroll. So, because you're usually contributing, a certain percentage out of your monthly paycheck is going towards your 401k, and then you're paying that money back that you borrowed against yourself.
Right now, we are actually able to offer the 2-1 buy down at all 3 of our communities. So that's pretty exciting. So even if you were building new, or if you were looking at any of our communities and wanted to buy a quicker move-in home, we have the opportunity to offer those options if it works for them to do the 2-1 buy down. So that just adds that extra layer of confidence if they're wanting to have the first couple of years a little bit lower. So we're offering that, but is there anything else that if somebody was exploring home ownership and they were really wanting to understand what their payment could look like, what would be that next step for them?
I would advise doing a pre-qualification. I have obviously a mortgage website. They can apply on our website. I usually get back to them if they apply in the morning or in the afternoon. I can usually have it completed by end of business day, if not the next following business day. And what I would do is it's a application, obviously, all the information plus your income and your assets. And then we do a soft pull credit report, which will not affect your credit score. And once I get that soft pull credit report, I'm able to price the loan because the credit report and the income does take into consideration how I can price out the loan. So it's not a vanilla, everybody gets the same rate type of a deal. Depends on your credit scores. It depends on what your debt to income ratios are. It depends on how much of a down payment you have. So I can't just answer flat out, oh, your rate's going to be this or it's going to be that. So I like to, obviously individualize each particular client. We take a look at their situation and then take a look at what the payments are going to be for them and what they qualify for.
Yeah.
Brian is a certified financial planner. Is that something you advise your clients to do, is to kind of learn what their monthly payment might look like, or their buying power?
Yeah, absolutely. And it's easier than ever to figure that out, right? You can go online, there are calculators and all sorts of things like that. And there are good rules of thumbs to follow also, but figuring out what you can afford and then finding out what you qualify for based on your credit score, those are all the first steps certainly to take.
Right? Yeah, and we're a local family builder, and we are also a local mortgage company. So you can come in and even meet with Tim in person as well to review it if you have any other questions, and keep that relationship and use him as your advisor on the loan side. So, right now we've touched on this. It's kind of the sweet spot. It's a perfect time to buy if you're looking to move, especially because if you have that need and you're looking to improve your life, it's not about chasing the market. It's about making the move based on your life and what's happening. And if the monthly payments make sense, then it makes sense to move for you. Especially if we're offering amazing incentives, because right now incentives are very favorable for our customers, and we are offering programs like a 2-1 buy down, and the pricing is kind of still a little bit of a lag. There is a price increase coming soon that we are on the horizon of experiencing, so we really are in that sweet spot right now in January of 2026 to come on in and explore what your payment might look like with Tim, and see if you could find the home that truly fixes what you're missing in your current home. That's what we want to help you do, is improve your life. So we're in that sweet spot, and I think we've covered a lot of things, from the Fed, the economy, the market, the interest rates, our 2-1 buy down, what DeYoung Properties has to offer, and how we can help get your monthly payment a lot lower. And so if you're interested in buying a new home, we hope you visit us soon. So thanks everybody for coming today.
Thank you.
Wait, I do have a really important question. Tim, are you in the running for the Fed seat?
No.
You're really hoping it's somebody right here in this room.
Man, that would be really great to represent Fresno.
Well, I would love to, but I don't have the knowledge to do that type of a thing.
Get out of here. Get out of here with that. All right, season 1 of Sibling Showdown winner. I appreciate y'all tuning in today.
Yeah. Season 2 winner. Okay.
Yeah.
All right. Thank you, everybody. We'll see you out at our Welcome Centers. We have 3 different locations right now, so visit our website to check it out.